A profitable business can still be exposed if too much control depends on one person. That person may manage key relationships, make major decisions, bring in revenue, or hold technical knowledge that is difficult to replace. If something happens to that individual, the company may continue legally, but the business can slow down quickly. This is where the key person life insurance becomes part of business continuity planning. My name is Shiraz Waheed and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain how key person life insurance works, why it matters to founders and multi-partner businesses, and how it can support partner buyouts, as well as how it fits within a broader international structure. A key person life insurance is a policy taken out by a business on the life of someone who is critical to that business. The company usually owns the policy, pays the premium, and receives the payout if the insured person passes away. The purpose is business continuity. The payout gives the company liquidity when the loss of that person could affect the revenue, operation, or relationship as well. This is different from personal life insurance, which is usually designed to protect a family. Key person insurance is designed to protect a company. If a founder manages major relationships, the business may need time to replace that role. If a partner owns shares, the remaining partners may need funding to buy those shares from the estate. In simple terms, the policy provides capital so the business can manage the disruption properly. Key person insurance becomes especially important when there are multiple partners or co-founders involved. In many businesses, ownership and operational responsibility are connected. One partner may control sales, another may manage investment decisions, and a third partner may handle banking or delivery. If one partner passes away, the issue is not only operational, it also becomes an ownership issue. The deceased partner's shares may form part of their personal estate. Depending on the jurisdiction, these shares may go through probate process before they can be transferred. During that period, the remaining partners may face uncertainty around voting rights, control, and decision making. The family of the deceased partner may also inherit an economic interest in the company. That can create practical issues if the family does not want to be involved, or if the remaining partners do not want a non-operating shareholder inside the business. Key person insurance can help solve this funding problem. The payout can be used by the company or the remaining partners to buy out the deceased partner's shares if the legal agreement are structured correctly. This allows the estate to receive value while the remaining partners keep control of the business and continue operations with less disruptions. The insurance policy alone is not enough. It should usually sit alongside a shareholder agreement, partnership agreement, or buy-sell agreements. The legal agreement explains what happens if a partner dies or can no longer continue in the business. It can define who has the rights to buy the shares, how the shares are valued, and when payment is made, as well as how the transfer should happen. The insurance provides the funding. The agreement provides the process. For example, let us assume three co-founders own a company. If one founder passes away, their shares may pass into their estate. Without planning, the remaining founders may need to negotiate with the estate while also managing clients, staff, banks, and daily operations. If the company has key person or partner protection insurance in place, the payout can provide liquidity for the remaining shareholders or the company purchase those shares. This creates a smoother continuation of the business. The family receives the financial value, the remaining partners avoid an unplanned ownership change, and the company has a clearer path to continuity. This is why structure should be designed before the event happens. Once a partner has passed away, it is much harder to create a clean funding and transfer process. Now, when it comes to who is a key person, it is identified by dependency, not just by job title. It may be a founder who drives growth, a partner who controls key client relationships, an investment director, technical expert, authorized signatory, or a person responsible for lender relationships. In an international structure, it may be the person who connects the operating company with holding companies, SPVs, foundations, or trusts. The key question is practical. If the person was no longer available, would the business lose revenue, decision-making capacity, banking confidence, or operational control? If the answer is yes, that person should be reviewed as possible key person. The amount of cover should be linked to the actual risk, including revenue exposure, debt, recruitment costs, working capital needs, or the expected value of a partner buyout. In a typical arrangement, the company applies for the policy and explains why individual is important to the business. The insurer then assesses the person being insured based on age, health, occupation, and the amount cover requested. The company pays the premium, and if the insured person passes away during the policy term, the payout is made to the policy beneficiaries. The policy should be coordinated with the corporate documents. If the intention is to protect revenue, the company may own the policy directly. If the intention is to fund a shareholder buyout, the arrangement should match the shareholder agreement. This is where legal and financial planning needs to work together. together. The insurance should match the commercial objectives, the documents, and the succession plan. Without that coordination, the payout may arrive, but the business may still face uncertainty around shares, authority, or control. National entrepreneurs, the structure needs extra care because several jurisdictions may be involved. The company may be incorporated in DIFC, ADGM, or mainland in the UAE or the UK or any other jurisdiction. The partner may live in different countries, and the assets may be held through SPVs, holding companies, or other vehicles. Tax treatment of premiums and payouts can vary depending on the jurisdiction. Residency and domicile may also affect how the wider estate is treated. If shares pass through probate in another country, the business may face delays even if the company itself is based in a well-regulated center. Dubai structures, including DIFC and ADGM entities, are often used because they offer regulated, structured, and internationally recognized frameworks. But the structure still needs to be coordinated properly. A regulated jurisdiction helps, but it does not replace proper agreement and governance. This is why key person insurance should be reviewed together with shareholder agreements, wills, foundations, trusts, and holding company arrangements where relevant. Insurance provides liquidity. Governance decides how that liquidity is used. After a key event, the business needs clear authority. Who can approve payments? Who can act on behalf of the company? Who decides whether the payout is used for working capital, debt repayment, recruitment, or partner buyout? These questions should be answered before a problem occurs. In multi-partner businesses, governance is especially important because the remaining partner and estate may have different priorities. A clear agreement reduces uncertainty. It protects the company, supports the family of the deceased partner, and gives remaining partners a defined process to follow. Where a foundation or trust sits above the business, its governance should be aligned so the control can continue clearly. Key person life insurance is useful, but it should be understood correctly. It does not replace the individual, automatically transfer shares, or remove the need of shareholder agreements, wills, governance documents, or succession planning. Its main function is to provide liquidity at a difficult time. That liquidity may allow the company to continue paying salaries, manage debt, reassure banks, recruit replacement leadership, or complete a partner buyout without draining operating cash. Timing also matters. Insurance and buyout planning should be arranged while the business is stable and all partners are aligned. Once illness, dispute, or financial stress appears, options can become limited. For asset protection and succession planning, timing and intent always matters. Structures works best when they are created as part of a planned governance framework, not as a reaction to an immediate threat. Now, key person life insurance should be viewed as one layer of a broader structure. A business may have operating companies, holding companies, SPVs, shareholder arrangements, and possibly a DIFC or ADGM foundation above the ownership layer. The holding structure manages ownerships. The shareholder arrangements manages the transfer rights. The foundation or trust may manage long-term succession. Key person insurance provides liquidity when a key partner is lost. When these layers work together, the business has a stronger continuity plan. The remaining partners have the funding. The estate has a path to receive value. The company has a clearer way to be operational. Ultimately, key person life insurance is about protecting business continuity, ownership stability, and control when the people behind the business are also central to its value. So if you're a founder, co-founder, or a partner in a business and you want to understand how key person insurance could support continuity, shareholder buyouts, and control if something happens to the key person, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.